This video covers Learning Objective 6, Account for Notes Receivable and Interest Revenue in Chapter 5, Receivables and Revenues. So let's get started. Before exploring accounting for notes receivable, let's define some key terms. Creditor is the party to whom money is owed. The creditor is also called the lender. Debtor is the party that borrowed and owes money on the note. The debtor is also called the maker of the note or the borrower. Interest is the cost of borrowing money. The interest is stated in an annual percentage rate. Maturity date is the date on which the debtor must pay the note. Maturity value is the sum of principal and interest on the note. Principal is the amount of money borrowed by the debtor and lent by the creditor. Term is the length of time from when the note was signed by the debtor to when the debtor must pay the note. Notes receivable can be classified as current or long-term depending on their maturity date. Just a quick reminder here about the difference between a receivable and payable. Up to this point, we have talked about accounts receivable and accounts payable. Accounts receivable has to do with an asset that customers owe us money. Accounts payable has to do with vendors and suppliers, and we owe others money. The same distinction holds true for notes receivable and notes payable. The lender will have a notes receivable while the borrower has a note payable. The creditor is also referred to as a lender. A borrower can also be referred to as a debtor. Here is an example of a promissory note. The principal amount of the note, $1,000, is the amount borrowed by the debtor and lent by the creditor. This 6-month note receivable runs from August 31, 2017 to February 28, 2018, when Lauren Holland, the maker, promises to pay Continental Bank, the creditor, the principal of $1,000 plus 9% interest. Interest is revenue to the creditor, Continental Bank in this case. We are going to go through several entries associated with a bank loan. These entries will all be done from the standpoint of the bank. We are focusing on notes receivable here. So here's the example to get us started. Jennifer White signed a 6-month 8% note with Main Street Bank for $6,000 on October 31st, 2018. Journalize the issuance of the notes receivable for the bank. We start the journal entry off by recording the date. Then we debit notes receivable for the $6,000 amount and we credit cash for $6,000. Again, remember that we are doing these entries from the standpoint of the bank who has the note receivable. A note receivable is an asset. We finalize the journal entry by making the memo line. Next in our example, Main Street Bank earns interest revenue during November and December. At December 31st, 2018, the bank accrues 8% interest revenue for 2 months, $6,000 times 8% times 2 divided by 12 months, which is equal to $80. We make the adjustment of 2 divided by 12 because the bank has had the note receivable outstanding for 2 months, November and December. The note was made October 31st, and the first date does not count. The interest rates are always expressed on an annual basis. We start the journal entry off with the date, and then we debit interest receivable, an asset, for $80. And we credit interest revenue for the $80. We then fill in the memo line, and that takes care of our adjusting entry to accrue interest on this note receivable at the bank's fiscal year end. Main Street Bank will report these balances in its financial statements as of December 31st, 2018. On the balance sheet, it will have current assets including a note receivable for $6,000 and interest receivable for $80. On its income statement, it will show interest revenue for $80. Now we fast forward to the collecting of the note on April 30th, 2019. We're going to do this journal entry out of order because it's easier that way. First thing I'm going to do is I'm going to credit note receivable for the $6,000. Next, I will credit interest receivable to remove the $80 balance that we had made for the adjusting entry at year end. Next, I'm going to recognize interest revenue on this note for January through April. We already recognized interest revenue for November and December in the adjusting entry. Now we need to calculate the interest revenue for January through April, which is $6,000 times 8% times 4/12, or $160. The 4/12 is to adjust for the fact that this note was held for 4 months in 2019. We will credit interest revenue for the $160. Now we can go back to the top and do our debit to cash because we have all of the amounts. The amount that the debtor will pay at note payoff will be the principal amount of the note plus the $6,000 plus the interest receivable, $80, plus the interest revenue, $160. We add all three credits up and it totals $6,240, which is the amount of cash the debtor will pay the bank. We finalize the journal entry by writing the memo line and we're done. Three aspects of the interest calculation deserve mention at this point. 1. Interest rates are always for an annual period unless stated otherwise. 2. The time element, i.e. 4/12, is the fraction of the year that the note has been enforced during the year. 3. Interest is often calculated for a number of days or months. It could be 3 months out of 12 or 90 days out of 365. Now we have a few knowledge check questions coming up to test your understanding of this material. After I read the question, pause the video and try to answer it. Once you restart the video, I will be walking through the answer for the question. Let's go! The first question reads, Gordon Davis signed a 6-month 9% note with First Bank for $90,000 on August 31, 2018. How much interest revenue will First Bank accrue at its year end, December 31, 2018? The choices are $675, $1,350, $2,700, or $8,100. The answer is $2,700, which is calculated as $90,000 principal times 9% rate times 4/12. The 4 is the number of months that this note would have been outstanding during 2018. The second question reads, the creditor has a notes payable. True or false? The answer is false. The borrower has a note payable while the creditor has a note receivable. That concludes our review of accounting for notes receivable and interest revenue. Thanks for watching.